So do you want me to go or anything else you need to cover? Or are we good?
Um, yeah, you can start with the,
Uh,
I don't know what's product.
let me share
Uh,
my screen here. Let me see. I can share, right? All right. All right. Well, hey, I want to first thanks for the time and set everything up. I appreciate you helping get me on here. Believe a lot of you got introduced to Lafayette Life recently through some of the agents. And we were having some pretty good success recently with you guys. So looking forward to growing that. And I'm here to support you. Myself, I have an internal partner in the home office who right now I don't know his status. I might be getting a new one soon. So we'll have another resource. But for now, continue to come to me for all the support, any questions, product training, illustrations, right? That's a big value add that we bring to the team. Being readily available, especially as you guys are getting moving pretty quick here. So which we love to see. So, I guess really for today's call, I guess I'll give you a high level, just maybe some simple product training. I would like to take you through the portal too a little bit because I feel like some people are just getting appointed, maybe haven't created their portal yet. They want to do that, and I'll show you kind of some caveats and different things you can navigate through the systems and where to run your illustrations and how to submit an application electronically. I think that would be a great start for today, and then maybe take you through a case design, simple case design of what we tend to see. A lot of what we do just high level, right? With whole life, we do some different concepts, but a lot of our policies are these higher early type cash value plays. The infinite banking concept is one of the strategies that we see a lot. The flexibility of our policies to be able to utilize the PUAs, the paid up additions portion, which essentially is your cash value, and have that strong, rich early cash value, as opposed to some other strategies, right? Um, we see a lot with UL out in the field. And again, whole life is a tad more conservative, a little bit more realistic, a little bit more predictable of an asset class. You're not really, behooving to some of the carriers who can, put the risk on the policyholder, right? The risk is on the insurance company at the end of the day. So that's the big difference when you look at UL versus whole life. All right. And I think this is something we say when you have access to your cash, you're in control, your capital. And it's a great alternative to some other investment options, right? Obviously, it also comes with life insurance as well, too, right? The death benefit, the living benefits, the chronic illness riders that come on these policies. It's a Swiss Army knife of your portfolio. In a lot of scenarios, it's the foundation, right? There's not many other tools out there that allow for you to have access, control, liquidity, leverage, the tax-free accumulation of wealth as well as the tax-free distribution of wealth. So again, all those things just tie a ribbon and a bow around what we do on a day-to-day basis. So if you haven't yet, I encourage you all to go to the Lafayette Life website. For you all, it would be the site is agent.llic.com, right? That's where you'll want to go to start. If you haven't gotten your agent code yet, if you've submitted your contracting through Experior, it's probably in the process of being done. We've got a few done in the past couple of days. But you'll come to this site. If it's your first time, you're just going to register here. You'll put in your information. All you'll need is your agent code. It's a 5-digit code, which you'll get from us. You'll get an email as well with a lot of this information. You'll need your date of birth. You'll ask for your social. Then we can verify everything, create your account. And this is where you'll have access to all of the systems, all the illustrations, your book of business, the e-apps, everything, right? So when you log in, you'll see something like this. I can come into my book of business. Excuse me. I can see um, all of my cases and where they're at from an underwriting perspective. I can get updates, right? I can just come in here and I can see what's needed on certain apps, issue requirements, putting, enforced book of business is just a dummy account we have. But again, you see everything there, right? So, That's important, right? Once you start submitting business. I think the other thing too is when you submit apps, right, in our illustration system and our e-app system are all linked together. So everything in Lafayette Life, what's nice is that we have the electronic platform so you can submit apps electronically, and then also we deliver policies electronically as well too. You have the option to do either or. You can still have a policy mailed to you to send to the client as well. You have that option. But essentially, you come in here and you're going to start a new case. Um, so before I get into the illustrations, I just want to talk a little bit about product at Lafayette Life, specifically, like I said, what we do and how we design policies. Um, we have a unique product that's called our Patriot is our flagship product. It's probably our top selling product. It's the good combination of high early cash value and death benefit and long-term performance. And it takes care of multiple client needs. So I want to spend some time on that because we've had a lot of success with it. We just rolled it out onto a rapid issue type platform. What does that mean? That means we are getting policies submitted, approved, and issued within 2 to 3 days on a whole life chassis up to $1 million. So having a ton of success there, especially with an Experior who, a lot of the policies you all are doing, a lot of more rapid issue, non-medical, accelerated type underwriting type policies. So we now are in that space. We've been there for the past 7 months, 8 months of this product. We just made some changes to it. And how we roll it out to the clients, but we're having about 72% pass rates right now on that product. So it's great. And we're seeing a lot of traction there from this group as well as um, Experior in general. So real quick, I just want to go through, aside from the Patriot Now product, which I'll cover here in a second, we do have 6 different other products, our traditional products. We have a single premium whole life policy, which is great for 1035 exchanges into. If clients don't want to pay premiums anymore, you have the ability to 1035 into that. So if it comes from a non-mech, it stays as a non-mech, right? It's more of like a cash reserve, cash alternative, right? If you have $100,000 sitting in a savings account doing nothing, some people will leverage that, put into a single premium whole life, get the leverage up death benefit tax free, having liquidity immediately, right? So that's a scenario. We have a 10-pay product, pretty straightforward. We have a heritage, what we call is it's pretty much a GUL alternative, the whole life. Strip down whole life to where there's really no cash value. There's some cash value accumulation, but it's gonna be the cheapest premiums out there. And then our Contender and our Patriot are two most popular products, right? They work very close, similarly hand in hand. Contender's a little bit richer on the death benefit side, a little less cash year one. Patriots vice versa. It's richer cash, a little less death benefit, right? So the 2 times I'll see within Xperia, right, the most popular products are probably the Contender and the Patriot, and now the Patriot Now, which is another policy. So if the death benefit's over $1 million, we can't use our rapid issue. So we will probably revert to a traditional Patriot or a Contender. The Contender we see a lot in juvenile policies as well too. Contender and 10 pays, right? So anyone 17 and younger, we do see the Contender a lot as well. So I'll show you what that looks like here in a minute when we go through some illustration training and go through that whole gamut. So just keep that in mind, right? What we do, again, we do base PUA blends. So if you've never seen how a whole life policy works, right? We call ourselves a modern whole life company. We do things a little differently. Traditional whole life, everyone thinks of, I have this permanent death benefit and it's going to take me 15 years to get good cash value. That's not the case anymore. Not the case with our designs, right? We give you good cash value day one, the way we design it. And we do it by utilizing term riders to offset the mix so we can have these richer cash values in the earlier years. And we have a 7, 10, 15, 20, and a 30-year term rider. So essentially it comes down to really how long do you want to be able to overfund this policy for, right? And age too, right? I'm not going to put a 30-year term rider on a 60-year-old. Probably gonna put a 30-year term rider on a 20 to 30 to 40-year-old. Potentially a 20-year term rider on a lot of those folks, right? 7-year, 10-year on some older people. So Don't get too caught up in that. It's just a matter of us being able to design the policy. It's very simple to run. You'll just have to kind of figure out, which one makes the most sense for your client, how long they want to overfund it for, and all that. So I want to get into running a sample case. Let's see here. All right. So I'm just going to run a value client case. And let's just say it's a 40-year-old. 40-year-old male. Let's do female. 40-year-old male, female in Georgia. Let's go. I'm going to do my rapid issue whole life policy. So when you choose your products, you sometimes you're going to come here to whole life. These are the traditional ones I just showed you. But if you're going to do the rapid issue one, you want to make sure you choose rapid issue whole life. So you're typically going to be somewhere in the middle there. We do have a simplified issue policy as well too, which I didn't cover on that sheet. It's not on there. So if you do have a simplified issue, it's really more for the smaller face amounts, right? Up to like $50,000, essentially for older folks who just want to get some sort of small policy. We do have that as well too. That's only like 8 questions on the app, and it's pass fail. But I want to choose my rapid issue whole life, and then I choose my products, and here's the Patriot now. All right, so I come in here. And very simply, these illustrations are so easy to run. I can click this solves button, and when I choose, let's just say I am paying monthly, and all I want to do here is solve for a base PUA blend. Okay. And let's just say I'm doing $1,000 a month. So I take the full amount, right? The annual amount, which would be 12 grand, but it's gonna be paying $1,000 a month. And then all I choose is how I want to break up that premium. So if we are doing these higher early cash values or the infinite banking concept, right? The typical rule of thumb is anywhere from a 40% base, 60% PUA to vice versa, right? I mean, you can go 30-70, you can go 60-40, you can go 50-50. The biggest thing to know is what happens is that the lower the base, the lower the permanent face amount, the weaker the dividend, the lower the commission, and the higher the PUA, the richer the cash value early on. Again, lower dividend, lower performance, but you have access to a lot more cash, right? So we always like to have a good mix of both. If I did vice versa, higher base, higher permanent face amount, death benefit, higher dividends, lower LPUA, less early cash, right? You'll still have good cash, but it's just not going to be as rich as it would be if you did a 50-50, right? Think about it this way. If I did a 50-50 blend here, or this 40-60 blend, 60% of my 12 grand is almost going right to the cash value dollar for dollar. 94 cents on every dollar goes right to the cash value, right? There's a 6% load on our PUA. So essentially, what that means is 94 cents on every dollar goes right to the cash value. Okay. So I'm going to set it up this way. You always want to make sure it equals 100%. This FPUA, I get this question all the time. What is that? I would just ignore that. 98% of our PUA options are used as LPUA. It's just so much more flexible. It tends to be just easier to use. And the minimum requirements are very little. The FPUA is a little bit more convoluted. It's typically for older folks. It does go to age 85, where the LPUA goes to age 75. So you're always going to want to use the LPUA, okay? And then what we do here is simply just hit avoid mech options. This is what we're going to add our term rider to be able to overfund the policy and have those early rich cash values. And it's a 40-year-old male, so I'm just gonna, or female, so I'm just gonna do a 20-year term rider. It gets me age 60. Pretty simple. There's other riders too that you can add on to this, like a waiver of premium, or the chronic illness comes automatically, so you don't need to choose that option. It comes automatically. And then all I'm going to do is just simply click this view illustration.
Hey Tom, let me ask you a quick question. Do you always need to get a term rider for the customer if they're like, say, 40 or 50 years old on in that scenario?
So it depends, right? On the Patriot, typically, yes, you're gonna need some sort of term rider if you want to have a kind of a heavier cash value. I'll show you a second option here too. Now the Patriot now, right? The rapid issue, you tend to have some sort of term rider cost, right? It's such a low death benefit product that you need some sort of term rider to offset it, right? Because a lot of that cash and a lot of the dividend, a lot of the premiums are going right to cash value. So there's another way I could show you it. Now, what it could do, it might not be on this rapid issue. It might be a little bit more traditional. There's still a chance it could go through with a phone call, but underwriting could be a paramed exam or blood and urine, something along those lines. So good question. I'll come back to that in a second. I'm gonna show you something. But here's how this looks, right? I mean, 12 grand comes in, $1,000 a month, and we see how rich a cash value is, right? I mean, 78.86 end of the first year. I mean, that's really good. I mean, we're what's that? Almost 78. That's 66% of the premium is in the cash value. So again, you're seeing the value here, and being able to how you blend these things up. Okay, so how does this policy work, right? Because look, you see face amount here, 102,000, but I have a death benefit day one of 219. That's the term rider, right? To go back to your question, I need at least $100,000 of term rider to be able to put that 60% of the premium towards the cash value. Okay. So that is a cost, right? I mean, obviously it's costing me 15 bucks a month. Now, again, it is also death benefit coverage. So if something did happen to us, it's going to be a death benefit paid out. But regardless, yes, I mean, at the end of the day, you got 15, you got 100 and call it 150 bucks a year going towards, a sunk cost, right? But if the policy being funded accordingly, you don't really feel that pain. Now, one thing we can do here, and what's so flexible about this policy, is that I could put on this type of scenario, I would not be able to put any more money into the policy above this $1,000 a month. You see here, minimum, I can drop it down to 425 because this PUA rider is so flexible, right? I can back off this 584 really whenever I want, right? And just fund the minimums. Now I can't put anything above that on this design right now as it is. But I have the ability to. Now, keep in mind, the PUA rider, what makes these policies really sing and allow for the flexibility and the performance is the PUA rider. So to keep it open, it's $500 in the first year, which we obviously are already covering off 1 month's premium. And then every year after, it's $120 to keep it open, right? So if we fund this whole thing the first year, then second year I want to drop it down. As long as I put the 120 in, I can at least go and fund up to that amount, right? And right now it's showing me $7,000 a year I can fund into this PUA, which I'm gonna fund every single year if I pay my $1,000 a month in premium, right? Because if I go 584 times 12, that's $7,019, which is right here. So I'm max funding this thing, okay? So what's beautiful about this though, that you can say, hey, a lot of people do these policies and they like the ability to put some more money into it if they can and have it go right to cash value. So I'm going to show you a scenario,
Quick
and this is
question.
how easy this is. I'm going to do the exact same thing. I'm going to hit avoid 20-year term, but I'm going to give the ability. Remember, I had a $100,000 term rider needed on that. I want to put an extra, maybe have the room to put an extra $10,000 a year. I don't have to do that, but I want the ability to potentially put some extra cash there, give and take, right? Maybe I get a bonus 1 month. Maybe I get, I did a project and I made some money. Maybe I had some extra cat income coming on a second job or some sort of side hustle, and I want to park some more money into this policy. But I don't want to be married to it. I don't need to do it. I just want to have the ability to, because all this is going to do is increase that term rider a little bit, right? So it's gonna be the exact same type of setup, but you'll see a little bit bigger of a term rider. So watch this. I'm just gonna do is hit view illustration. Again, I never have to put this extra 10 grand in. Never have to. I just want it there to be able to, potentially. And I could put in 3 grand extra, 2 grand extra 1 year. I could do the full 10 1 year, right? I got a lot of flexibility there. But I just want to show you what happens here so you get an idea of how these policies work, logistically and mechanically. So here we are, same $102,000 face amount. Now look what happens. My term rider went to 300,000. It was 100,000 prior, right? So to be able to do the monthly amount plus the potential to do an extra 10 grand, I need $300,000 of term rider coverage. Okay. Now look what happened here. The max I can do is at 16,680, right? So it's taking into consideration the 10 grand. So yes, did my cost go up by almost $30 a month? Right? Not even. A little less than that, right? So, but it gave me the ability to have that money to park it in. Now I look at it this way. I say, okay, it's gonna cost me an extra $30 a month. But if I do utilize that, great. At the end of the day, I still have this term rider here. It's additional death benefit coverage, right? And if I don't ever utilize the extra 10 grand here and there, I can always convert a portion of this too, right? Keep that in mind. This term rider is convertible down the road until the end of the term period. So again, I just want to show you the inner workings of these policies to get a more of an educational feel as to how you can tweak these. Right now, I can go on this term rider as much as 12 times this base amount. So realistically, I could put $1.2 million of term rider on this policy if I wanted to. I wouldn't say it's the most efficient way, because realistically, if you're only putting $1,000 a month in, and you leave room for 70, 80, $90,000 a year to go in the PUA, you're probably not going to fund it. So it's going to cause drag on the policy. So just keep that in mind, right? Larger clients, larger premiums, yes, that's the conversation we had. But regardless, this is one way to do it. One other scenario I want to show you. Let's just say,
Just quick question. So essentially, that's not something you would offer to a lower end policy. That would be a higher value policy, right?
yeah, all you're going to do is just change the monthly amount. I mean, again, I have people write $100 a month policies, and I have people that do 10,000 a month policies or more, right? So it's just a matter of, changing this premium, right? So if I was only going to do, $300 a month, it's still the same thing. I'm just changing that monthly to 300, right? Nothing really changes. I mean, you're going to have some, the amounts will be lower, right? The death benefits will be lower, but, I might only need a $25,000, $50,000 term rider here, but nothing changes, right? At the end of the day, I mean, people always say, well, what's the sweet spot for this? I mean, look, everyone's an out candidate in this type of strategy, right? I think this is a safe money alternative. This is our protection within our portfolio. If I can accumulate some good cash here and give myself the ability to access it, leverage it, utilize it a much more efficient way than maybe using other ways of alternative lending strategies and borrowing mechanisms, right? You are the bank. You make the terms of if you want to borrow this money, what you're going to do with it, right? Go get a car loan or whatever. You pay yourself back, right? So it doesn't matter, right? So you can still do lower face amounts. I mean, this is a $25,000 minimum, so you probably couldn't go much lower. You can go a little bit lower on this type of client for this policy. We do have other ones that can go below 25,000. And keep in mind, anything's under 100,000, it's a non-med as well. So, yeah, I mean, you can do anyone can do this, right? So I should go back real quick to that same sample. And let's just say I'm only really looking to do $1,000 a month, but maybe they have this lump sum of cash sitting somewhere that they want to put to work. They want to utilize it. And they really only know they're going to put in the first year, right? I should have $10,000 extra every single year they could do. This person's not going to do that. They know, I want to pay this $1,000 a month, but I do have this $20,000 sitting here that I don't need, that I want to maybe get access and leverage it into the policy in that first year only. Well, all we would do here is choose this single premium paid up addition rider. I'll put in 20,000. All right, and I'll do the same 20-year term rider. And you'll see here, right? What's happening here?
Mm.
But we can put that 20,000 in the first year, right? So now I've just beefed up my cash value to where I have this money readily available, right? So it's just an SPUA, it's a single premium paid up addition rider. It's just in the first year only, right? It doesn't cost as much from a term rider perspective. We have the ability to do that. So it's just another option, another piece of the puzzle. Again, this client just knows they're not going to do it every single year, but they want the ability to get stuff a little bit extra cash in that first year to get the policy a little bit more cash rich and have access immediately if they need to. Okay, so those are different couple scenarios, right? I mean, there's so many different ways you can look at these things. You can break them up. My best regards is to hop in here and just mess around and see what you can do on your own. And then again, we can always do more trains on these too. I want to go back to the question though about what someone said earlier, not needing a term rider. So again, with this Patriot now, the rapid issue, really the only unless you do an all base policy, you're probably always going to need some sort of term rider on this one, right? Even if I go an 80-20 blend, I might not need a term rider in this scenario, but I just want to see and to show you, right? Yeah, see, I still need a term rider.
Will it tell you?
So it's probably
will it
a
tell
very
you,
small term rider, only 25,000. But I still need something in there to be able to overfund that extra $200 a month into the PUA. So again, that cost is very minimal, right? It's $4 a month. But on this product, I'm typically going to need some sort of term rider, unless I do an all base. If I did 100% all base policy, I would not need any term rider. Okay. Now, so again, we're kind of leaving the rapid issue whole life option. Again, these ones are getting approved in 1 to 3 days, right? No underwriting, no parameds, no exams. If we go the traditional route, or I should say traditional, but a little bit more of a traditional policy, my contender policy is one that I don't really need a term rider. So I have people who do like the contender for that reason. Now, you still have to have a pretty heavy base, like 60% and 40 PUA. But watch what happens here. I'm just going to run this illustration. I didn't choose the avoid mech, so I'm not putting any term rider on here. What's going to tell me is that, hey, you can fund this for 20 years before it would mech. And what that means is I just can't put any more money into the PUA rider, right? So year 27. So I basically can fund this thing without any term rider with 40% of my money going right to the PUA. All right. So it's one less cost that I got to worry about. So, again, you'll see maybe not as cash rich early on as that other Patriot now because I'm using the term rider. But long term, it probably does outperform because I'm not paying that extra cost for the term rider. Okay. So it's just something to consider, right? And I know people who don't like the term rider or think that's a sunk cost. Well, then maybe this is an option for you. But at the end of the day, that is one way you can go, and you can just. Now I wouldn't be able to I'd have to drop this down to probably the base premium in this year because of the mech option. We'll never let the policy mech unless you tell us to. We'll say, hey, you sent us too much money. Here it's back. Or the policy's gonna mech, right? And if you said, no, I want it to mech, we'd say, okay, sign this form. So just know that, right? There are safeguards in place to not allow policies to mech when you're from overfunding too much, okay? So that kind of goes back to answering that question someone had earlier. Now, let's take it a step further because this is the policy I tend to use more for juvenile cases because of that exact reason. For juveniles, cases 17 and younger, we don't do any sort of underwriting. We do ask that you answer the medical questions on the app. There's about 15 yes or no's. Most of the time, every question is no for the juvenile. But let's just say we do have a 15-year-old and we can't do term riders on juveniles. We just don't allow for it, right? I mean, very rare you would buy a term policy on a kid anyway. So that's why we don't allow for you to go buy these big, fully loaded policies on children. But we can certainly do these types of designs. So what I tend to see, right? Same exact thing I just showed you, but I'm just going to change this. And you can do this 60-40. It really comes down to how much cash, but I wouldn't go any more than 50-50. I think 50-50 could, be an issue, but you go with 60-40 blend on a juvenile. Again, we can't use term riders ever on a juvenile. That's why you see the avoid mech is just not even available. But you'll see here, year 32, I can't overfund it anymore. But same thing, right? It's a juvenile policy. I can't use term riders. I have a little bit richer cash than I did on the 40-year-old. But again, this is how these would be designed for younger clients, right? The juveniles. Now, again, these get approved. I mean, every now and then I've really never seen a juvenile case declined. For very, very large policies, we could potentially pull medical records. That'd be the only underwriting. We never require a paramed exam or client to do any kind of underwriting. So keep that in mind, right? So that question goes hand in hand with how you design these, right? So if somebody wants the early cash value of a policy, then you got to use PUAs, you got to go with the contender. If you don't, if the cash value in the first few years is not a necessity, but you still want to see decent cash value and you do an all base, then I would probably go Patriot because Patriot's going to provide a richer dividend than a contender. So again, just keep that in mind, right? Because in the Patriot, it's really the only thing you can do is an all base on a juvenile because you can't put term riders on there. This contender, because the richer face amount than the Patriot, it allows for some flexibility to build in the PUAs.
Hey, I'm sorry to interrupt. I just want to be sure. Are we going to get a copy of this recording?
I'm assuming that they were recording this, so I would imagine they can send this to you after. Hopefully, this isn't my Zoom, so I would assume theirs is.
Thanks.
Hey, Tom, I got a quick question. In this scenario here, if you increase the base, would it still mech? Is this mech at 32 years?
So if you did increase the base, let's just say, and again, right, it's just telling hey, just a heads up, you're gonna have to back off the PUA, right? All that's doing. But if I do increase my base, so it's gonna say, hey, it's gonna mech in probably year 52 or 55. Let's see what it says. Let's see how close I am. All right, age 40. So again, nothing's getting mech day one and not for a long time, right? And who knows how you fund this thing all along. But if you were like, sometimes people just get nervous with seeing these things. So what I just say, all right, well, if it's going to make it year 40, you can go into this riders tab and you can just come down here. This is the PUA breakdown. And I can just stop funding the PUA. That's all it is, right? Again, if you were to fully fund this in year 40 and give us the full 12 grand, we would say, hey, you can't put in the PUA anymore. Here's your $3,600 back. And you keep that, right? All you can fund now is kind of like the minimum. Okay. So, see, I didn't get that mech error there because I pulled it off. So, in the 40th year, it just dropped down to the 8,400.
Got it. Cool.
But, so again, I'm trying to get you to understand the base, the PUA, the differences. If you increase it, what can happen if you decrease it, right? You might need more term rider for the heavier blends. You need less or maybe none for these types of blends. Patriot now, you're probably always going to need some sort of term rider on a blended policy. The contender, you can get away with not needing any term rider. So again, this is all part of the designs and just what you're trying to provide. But again, rule of thumb, 40, 60, 50, 50 is kind of like the IBC practitioners out there, right? That's what they preach. If you had to take a one rule of thumb. Now, again, I've seen people do heavier blends, like a 70-30 and leave the room for the extra 10 grand a year, right? Because if they did fund that 10 grand, now you're probably closer to a 40-60, 30-70, right? So again, there's different caveats, different scenarios. You can do a million different things with these. It's just going to come down to really overall what the client's looking to get out of it. Now remember too, standard rating or better automatically included is the chronic illness that comes on automatically endorsed in the policy, right? So it's not a rider. You're not paying for it. You can't even choose to have it taken off. It's automatically in the policy, right? You're not paying for it. So you have a chronic illness, 2 of the 6 ADLs, severe cognitive impairment, as well as what we call a specified medical conditions. Basically, your critical illness rider, the one-time hiccup, the heart attack, stroke, cancer, kidney failure, major organ transplant. You can get a one-time cash influx as well too, right? So those benefits come as well, standard rating or better. If you are table rated, we don't include those riders on there. So just keep that in mind as well. And then when you run an illustration, right, I can take this and I can go right into my application, my e-app. All I gotta do is click on the application here. And everything, the last illustration you run is going to transfer over to the application portion. So some of this stuff's going to already pre-fill. And then we go through and fill out the app. I'm sure some of you have seen this before with iPipeline, but you got to get all the green check marks and then get to the end and you get signatures, whether you're emailing it to the client for e-signature or they're there in your office and you choose the face-to-face option. Again, everything can be done fully electronic. All right, so I'm going to stop there and I want to answer some questions if there's any out there. Because I do have a hard stop at like 2:10, 2:15 the latest.
So I just have a quick question. In regards to the LPOA, the base. Can you just talk briefly about that really quick? Because I'm starting towards the end.
I'm having a hard time hearing you. Can you repeat
No,
that?
I'm having a.
Now you're muted. You're muted. Oh.
I think you gotta turn the volume down on one of the devices.
Okay, so now I have you on my phone.
That's better.
I apologize. So in reference to the LPOA versus the base, can you just speak briefly about that? Because I came in after you were kind of discussing, so I missed it.
Yep. So I think, again, let's just go the PUA. Think of that as, hey, this amount of whatever allocation is going to that PUA is the amount going right to cash value, right?
Okay.
94 cents on every dollar goes right to the cash value. So we call that a 6% load.
Okay.
A lot of carriers I've been doing this with Lafayette for 6 years now. I came from the IUL world, spent 5 years there. I've never seen a company with a cheaper load than that. Some are 10, some are 15%, right? So that 6% is kind of your step up of a cost because it's always buying more death benefit. But 94 cents on every dollar goes right to the cash value. Okay, so that's your cash value, a component day one. The base is more your permanent death benefit. Now, the higher the base, the higher the face amount, the permanent face amount, also the richer the dividend, okay? The lower the base, lower the face amount, lower the dividend. But then if you have a lower face, you have a higher PUA, you're going to have richer early cash value, okay? If you had higher base, low PUA, you're going to have low early cash value, but you're going to have higher long-term, maybe better dividend performance long-term. So that's why we try to find in the IBC practitioner world a healthy blend of the two, right? 40 base, 60 PUA is kind of like been the rule of thumb. We've kind of seen this shift to 50-50. only because some of our policies have become richer in dividends. So you really can't go wrong. But I always say this, look, at the end of the day, I mean, you're bringing a valuable thing to your clients. Um, the richer the PUA, the less commissions, right? That's part of this, right? Is that, hey, we're not here to make a ton of money on a bump, but you do, 10 of these, you're going to do very well. Because again, the base is kind of driven by the commission, right? So that's almost like your target premium in a way, the base premium, if you want to look at whole life compared to IUL and how you get paid.
Okay.
So just keep that in mind, right? It's kind of a balancing act between the two.
Makes sense. Thank you.
Question is, so LPUA is pay out the interest or dividend?
Can you repeat that?
LPUA, that the
Yeah.
portion of additional cash. So will we credit for the dividend, right, or the interest? But
Yeah, so the PUA does earn a partial dividend interest, right? The PUA is interesting though because the dividend that is going to drive the policy and performance is going to be what the base of the base dividend, right? Because that's ongoing. Every single year you're paying the base premium or every single
Yeah.
month. The PUA is not always required, right?
Mm-hmm.
So you may not pay it. You might take some time off. You might back it off. And then when you pay it, right, it's a paid up addition, right? So it's almost like a one-time payment. So again, yes, there's a dividend interest credit, but it's not going to be on a scale as rich as the base portion, right? You're going to still earn interest on that money. And collectively over time with compound interest between the base dividends and the PUA dividends, it's going to grow very, very aggressively between the two, right? But there is almost a two different dividend scales because a PUA, right? Hey, you put it in one time. Let's go back to my example that I left the room for the $10,000 extra. If I do that one time in the first year, okay, I'm going to get an interest off that, but it's not guaranteed that every year I'm going to put that 10 grand in.
Yep.
Right.
Okay.
So
So
it is
what's
almost
the-
like a one time.
Yeah, what the premium fee for that portion? You may already say that, but I don't hear it. I don't
I
hear
mean,
it.
essentially 6%, it's a 6% load. So,
6%, okay. Okay.
anytime you use a PUA contribution, right? The big part of the nice thing about it is that 94 cents on every dollar is going right to your cash value.
Okay.
And it's
Okay.
it's available 15 days later to have
How
access
about-
to if you need to.
How about the portion of the base? You have to pay
So
the
the-
premium fee too?
Well, look, in whole life, you have guarantees. You're paying for guarantees, right? I mean, that's the beauty of whole life versus IUL is that there's really no fees. There's no cost of insurance. You're paying for guarantees, right? So
No, I mean the premium free, like when you put it in, you have like 6% premium free. So though like I put in 12,000 per year, so that will be charged one time premium free 6%, or just the 50% of the LPUA will be charged.
yeah, so just the portion going to the LPUA is going to be essentially charged, right? There's only a portion, right? So if I look at this illustration, right, if I did an all base policy, I'm not going to have much cash value day one because it's all going to the permanent side of the policy, right? So, look, watch. If I do this, if I just did 100% base and essentially I wouldn't have any really cash value. I'd have a little bit of cash value day one, or let's say if you were paying annually, but you're not going to really see a nice increase until the dividend credits at the policy anniversary, right? So, look, I mean, I have a little bit of cash value, but really it's coming from the dividend. So my cash value is 26.53 at the end of the first year. My dividend is the same amount, right? Because I'm basically just paying for permanent death benefit. This is kind of your traditional whole life, right? So now, yes, my dividend's larger and I have a bigger death benefit, but my available early cash is much lower, right? So if you want to talk about a fee, essentially you're paying 12 grand for the permanent death benefit with no cash value until the end of the year when I get my dividend. If I go back now and I do a 50-50 blend and I throw a term rider on there, now you're going to see the other 50% is still going to that permanent death benefit. It's going to drive the dividend, but the other 50 is going right to cash value, right? Over time, that base premium accumulates the dividend and it compounds, right? But you're early on, you're not going to have a whole lot of cash value from your base premium going towards it, right?
Yeah.
So here's my scenario, right? I mean, 50-50 blend. Yeah, my dividend's lower, right? Before it was like $2,300. Now it's 1434, but I got end of cash value the first year 7133. So I know close to 5,500 of that is available because of the portion going to PUA.
Mm-hmm. Yeah.
And again, and vice versa, my death benefit came down because my base is now lower.
Right, right. Yeah, because I don't see you know, I've been on IUL is break out really clear how what the percentage charge for premium you put it in, what the percentage charge for surrender charge, all kind of stuff. They give you the thing. It's really clear. But in here I try to do the thing, but I don't see it. So that's why I asking.
Yeah, and again, because I mean, again, you're
Mhm.
paying this, right? These are your guarantees, right? An
Yeah.
IUL, the guarantee com after 20 years goes to zero, right? Year 21, the guarantee com goes to zero, regardless of what your premium is, right? That's how most IUL carriers operate. Here, your guarantee is always here. You pay this premium, you're guaranteed this column, right? This is worst case scenario. This assumes no dividends.
Mhm.
This obviously assumes dividends of 5.75, right? Yes, IUL does a cool job of breaking down the cost of the policy, right? But what they don't do is they don't tell you that, hey, these index caps can adjust every single year, right?
Yeah,
These costs of these insurances can go up
yeah, I
all the
wish
time.
this one is a little bit more clear, is better. So I don't know, but
Yeah.
anyway, like, you know, like the premium charts, we don't see in here, and then surrender charts. Of course, it's have
There's no
surrender.
surrender, there's no surrender charges in whole life. You know, there's no surrender period in a whole life policy. You know, what you see here is what you have access to, right? I mean, yes, it's not your
So you
full.
said no surrender chart, but I put in 12K in it like as second year, and I cancel it. So I only take it out 700 7,133.
Correct.
So you said there's
Correct.
no not factor in the surrender chart. It's not right.
Yeah, but if I buy IUL and I have
No, I'm
this
just
same
saying here.
amount,
I'm not
I'm,
don't factor IUL in here, but I just have a question. So let's say this one the first year I put in 12K, and then what some K happened, like happened second year I cannot continue the policy. So pretty much like cash, you know, next cat value I can take it out as 7,000, right? 7,000.
well, if you were to, yeah, you would
Yeah,
cancel the policy with cash value
7,133.
7,133.
Yeah. So,
I mean, at the end of the day, there's still life insurance components behind this, right? I mean,
yeah.
it's a predictable asset class. I know what I'm getting every year. Right now, I have an IUL, and I keep it for one reason, right? Tell people how my caps have went from 13% in the third year. They've been 7.15 for the last 4 years. Right now, I'm earning zero credits because the way the market's performed. I have no credits now the next year easily. And now it's going to take me another year probably to recoup that. So, you know, again, this is a predictable asset. This is more the one that, hey, you know it's there, you know you have access to it, you know you're going to earn every single year. I've been in my whole life for 3 years. I borrow from it all the time. I've never touched my IUL. And to be honest, it's still in surrender. There's no point. So again, it's more about the mindset of how they can work together. To be honest, they can complement each other. This is more your bond alternative portfolio, and if you want to shoot for the stars in IUL, you know, compare it to an equity return,
No,
right? But I still,
I'm just like I'm just trying to understand over here, but not compare with IUL, but certain number, so, you know, so like I said, it's the second year in you put 24,000 in, and something happened, right? Some customer they cancel policy and you too. So how
yeah, I
much they can
understand.
get it out? So you know they give the portion of it. So of course I understand the other portion it pay for the cost of insurance. But mm,
Yeah, I mean, that's you can back off that PUA contributions too. That's
Yeah.
very flexible. You can use portion
Yeah,
of your cash value. There's a
yeah.
lot of different things you can do. You know, again, I'm not saying you can't walk away. We have people
Yeah.
surrender as well, but
Yeah.
there's flexibility behind using these PUA riders, put it
Yeah,
that way.
yeah.
Okay, I got 7, 8 minutes. Is there any other questions? Lam?
I have a question regarding, can you guys hear me?
Yeah, I can hear you.
Okay, so what I've been trained that whole life have the guarantee interest and dividends. So dividends is a non-guarantee element. So according to the illustration right here, the only thing that I see is the dividend. So it's no guarantee interest, right?
So this is your guaranteed interest right here. This is your guaranteed column, right? So think of this as your worst case scenario. If we never paid, Lafayette has been paying a dividend for 121 years, right? Every single year we've been in existence. So if we didn't pay dividends, which is highly unlikely, you know, this is your worst case scenario, guaranteed, right? It goes out forever, right? Now, what this is non-guaranteed is based on the dividend, right? It's based on historical dividend. And, you know, we hope that it would be in around this ballpark of this 1434, 1874, and so on and so forth, right? So yes, is there a chance this number could be a little different? In a perfect world, it goes up, right? If we declare a higher dividend next year. But we've always been a pretty conservative company where we keep our dividend right in line with what our portfolio earns, right? So we know our policyholders are here for the long term. We're a very highly rated company. We look 30, 40, 50 years out, privately held company, right? So yes, and that being said, the dividend of 575 is not guaranteed, but history has shown that it's pretty darn close.
So for
So
the
for the-
non-guarantee element, that's the only dividends, right? That dividends is the only option, like only
Correct.
thing that
Credit
you have.
return.
No, like
Yep.
no guarantee interest plus dividend, right?
No, you'll always get the guaranteed interest of 2%, right? Worst case scenario, but you're always going to have this account is probably always going to be outperforming the guaranteed account, right?
Okay, I get it now. Thank
I
you.
mean, if there was ever a day where our dividend dropped below 2%, we got bigger issues in the world, let's put it that way. I mean, we've been at 5 or above every single year for the last 120 years.
That's great.
And Lafayette
So-
Life has one of the richest balance sheets in Western Southern, all of the industry. So
Yeah.
very,
So
very
for the
cash
perfect
rich.
illustration, what the dividend we use in here?
5.75.
5.75. Awesome. Thank you.
Any other questions?
And then earlier you touched base on the critical illness. So in case is like happen and the company pay out, they give you lump sum part of from your death benefits. What the percent they give it out? What the max percent they can give it out?
It's a calculation that we use. Actually, what's really cool is we do a good job of showing this. So in the back of every illustration, you can see here
Mm-hmm.
the breakdowns. So we have our chronic illness values, we have our specified medical conditions, and we have our terminal illness, right? Everybody gets terminal illness.
Mm-hmm.
If I had a specified medical condition, let's just say at age 55, I had a heart attack, I could take $695,000 off my policy as a lump sum, right? Now it's going to reduce my death benefit drastically. Now I'm down to 637, but I have the ability to take a lump sum depending upon the severity, right? And same with the chronic illness, right? I could take a lump sum of 920,000 if I was chronically ill, or I could take a periodic payment of 666,000, right? The periodic payment is anywhere from 3 to 10 years, right? So you have some options here on how, and this is indemnity claim, right? So we're not asking for receipts, reimbursements. You just tell us how much to pay, and we'll send you the check.
Okay. Right. So you have two options.
So you have plenty of options here. when it comes to these values as well on the chronic and the specified medical conditions. And again, this comes standard rating or better automatically on the policy.
Mhm.
Any more questions?
So when you take a lump sum, you're done with policy, right? You're done.
If you cancel, you mean, or lump sum from the
I mean,
on the
like
benefits?
chronic illness, if you take a lump sum,
No, because you technically, depending upon when you took it, if you want the policy to stay in force, you got to continue paying premiums, right?
mhm.
So if you said, "Hey, I took a lump sum of 920,000, but I still have a $412,000 death benefit remaining that it's still going to earn dividend interest." Now I got to make that $12,000 premium payment unless I had some sort of waiver of premium on my policy. That's an option too, but we didn't choose that in this scenario. But if people do choose waiver, then we would waive premiums. But yeah, I mean, you still take the lump sum and there's still a death benefit. At age 30, my cash value or year 30 is 693, right? So I could take the whole thing and walk away if I wanted to. But again, I still have to pay the premiums if I keep the policy in force and want that extra death benefit coverage still there.
Okay. So in the project plan is either you pay up to 75 years old or 30 year, whichever is longer. So after that, you don't have to contribute in, or it's done. Is the
So
policy
this policy, for example, goes to age 95. I mean, again, most people aren't doing this, right? You can reduce pay up. You can premium offset. You can use portion of your cash value to offset premiums, right? There's a lot of different ways you can walk away. For example, and I have to hop here in about 2
Yeah,
minutes.
this one is gonna go up to 95 or 30
Yeah,
years.
so it truly would go to 95. Our Patriot
Mhm.
goes to age 75.
Yeah.
But like if I wanted to just hop in here and I just wanted to show, hey, 20 years and be done, I can reduce pay up the policy, right? You're basically
I see.
turning it off. We're putting a guarantee in place. There'll be a small reduction of death benefit, but you're basically saying, hey, I don't want to pay anymore. I can still earn interest. I'll still get dividends. But look what happened, right? It went from 906 to 773, right? So my death benefit does drop a little bit, but it's guaranteed up. It's paid up. I still have access to my cash. I'm still earning dividend interest. It's still a non-MEC, right? I just can't go back and fund it anymore. So we do see this a lot. Even though it's a true pay to 95, a lot of times they're stopping early. They're doing some sort of mechanism to offset the policy or not pay. Now, at this point in time, I got 12 grand coming into the policy. My dividend's already greater than my premium coming in, and my increase in cash value is almost 3 times as much as my premium. So at this point, this is probably my best performing asset in my portfolio. I would love to make this premium payment, right? So again, this is all part of the story, right? Part of what makes whole life beautiful. Again, there's a lot of things that we can have a whole other conversation on IUL. I came from that world. I know it very well. I don't ever bash it, right? I just tell my story. And again, I still own it. And in a way, I think they complement each other very well. But regardless, that's my story. So I'm actually hopping on a call here with a gentleman. I've heard it, Garrett Gunderson, but I'll be on a call with him right now. He actually wrote the book, which is a great one. What would the Rockefellers do? Another great book. If you get a chance, it's clients read that and they're ready to buy if they read it. So check that book out as well too. But anyway, I do have to hop on another call. I want to appreciate all I hop on here. Appreciate your time. We can do another one of these as well. Be more than happy to host you again. And if there's any questions or illustrations, let me know. Feel free to reach out. I believe you all have my contact. And that'll be it.
Awesome. Thank you so much for your time. It's great info.
Thank you, everybody.
Thanks, Paul.
Thank you.
Thank
Take
you.
care.
Tom.
Thank you.
Have a good day. Bye bye.
You too.
Ok,
Thank you,
vậy
em
mình
Linh. Thank you mọi người.
dạ. Vậy mình on Zoom mình off Zoom ở đây ha. Cảm ơn các
Yes.
anh chị. Mình có câu hỏi